Understanding hyperinflation in multinational operations. Hyperinflation presents unique challenges for multinational financial reporting because rapid declines in purchasing power distort the value of financial statement items. A hyperinflationary environment generally exists when cumulative inflation exceeds 100% over a 3-year period, equivalent to approximately 26% annual inflation. In such economies, local currencies depreciate rapidly, causing translated financial statements to understate the economic value of assets and operations if conventional translation methods are applied. As a result, accounting standards require special treatment to preserve the usefulness of financial information. Analysts must understand how hyperinflation affects asset values, liabilities, earnings, and financial ratios when evaluating multinational firms operating in unstable economic environments. Hyperinflation accounting under U.S. GAAP. Under U.S. GAAP, a subsidiary operating in a hyperinflationary environment is treated as if its functional currency is the parent company's presentation currency. Consequently, the temporal method is required for remeasurement. Monetary assets and liabilities are translated using current exchange rates, while non-monetary assets and liabilities are generally translated using historical rates. Any resulting remeasurement gains or losses are recognized directly in the income statement. Because non-monetary assets are not adjusted for inflation under U.S. GAAP, translated asset values may appear significantly lower than their economic value. This treatment often increases earnings volatility and can materially affect leverage, profitability, and asset turnover ratios. Hyperinflation accounting under IFRS. IFRS takes a different approach to hyperinflation. Rather than applying the temporal method, IFRS requires the subsidiary's financial statements to first be restated for inflation and then translated using the current exchange rate. Non-monetary assets and liabilities are adjusted using a general price index to reflect changes in purchasing power, while monetary assets and liabilities are not restated because they are already expressed in current monetary units. Restating financial statements generates a net purchasing power gain or loss that is recognized in earnings. This method better preserves the real economic value of assets and liabilities and generally results in higher translated asset values compared with U.S. GAAP treatment. Multinational operations and effective tax rates. Multinational firms often operate in numerous tax jurisdictions with different statutory tax rates. As a result, the company's effective tax rate frequently differs from the tax rate of its home country. The effective tax rate depends on the geographic distribution of earnings, tax incentives, transfer pricing arrangements, and local tax regulations. Analysts should evaluate how shifts in profitability among countries influence future tax expenses. For example, increasing earnings in low-tax jurisdictions may reduce the effective tax rate, while greater exposure to high-tax countries may increase it. Understanding the relationship between foreign operations and taxation is essential for forecasting earnings and valuing multinational enterprises. Sales growth and currency effects. Sales growth reported by multinational companies may result from several factors, including changes in product prices, sales volume, acquisitions, and foreign exchange movements. Because revenues generated in foreign currencies must be translated into the reporting currency, exchange rate fluctuations can significantly affect reported growth rates. Analysts should separate organic growth resulting from price increases and volume expansion from growth caused solely by currency movements. Organic growth is generally viewed as more sustainable and provides a better indication of long-term business performance. Failure to distinguish these components may lead to incorrect conclusions regarding competitive strength, market demand, and future revenue prospects. Currency risk and financial statement analysis. Currency fluctuations affect not only reported earnings but also asset values, liabilities, cash flows, and future operating performance. Management discussion and analysis, MD&A. Disclosures often provide valuable information regarding foreign exchange exposures, sensitivity analyses, and hedging strategies. Companies may use currency swaps, foreign currency denominated debt, or other hedging instruments to reduce exchange rate risk. Analysts should examine these disclosures to evaluate the potential impact of future currency movements on profitability and valuation. When disclosure is limited, sensitivity analysis can help estimate risk exposure. Understanding currency risk is critical because foreign exchange movements can materially influence financial results even when underlying business operations remain unchanged.